Okay, let's dive in. You can't really miss it. Nuclear power is suddenly a really hot topic again.
Absolutely, especially with all this talk about AI and data centers needing just enormous amounts of energy.
Exactly. And one name that keeps popping up is NuScale Power. Now, the article we're looking at today, it points out something pretty striking about them.
Uh-huh.
Well, their market cap is sitting around $11 billion. And get this, the stock is up like 360% in just the past year.
Wow. Yeah, that kind of number, I mean, that definitely makes you sit up and take notice, especially in a sector with so much future hype.
It really does. But this source we're using, it's not just riding the hype train. It actually takes a step back, looks beyond the NuScale buzz,
Okay.
and it raises some, let's say, potential flags for investors. And in fact, the author names 2 other industrial stocks they think will actually be worth more than NuScale in 10 years.
Ah, interesting. So it's offering a counterpoint based on, what, financials,
Yeah.
operations.
Yeah, exactly. It's digging into NuScale's current situation, the financials, the operations, and comparing it. So our mission here, really, for you listening, is to unpack the arguments from this specific article. We want to understand the author's concerns about NuScale and then see why they're pointing to Rocket Lab and Rivian as maybe better bets long term.
Right, focusing just on the perspective and the data presented in this source material.
Precisely. Think of it as a quick way to grasp one particular, pretty pointed analysis of these companies.
Okay, makes sense. Let's get into it.
All right, so let's start where the article does. A pretty critical look at NuScale. The author immediately flags what they see as the main issue.
Which is?
Despite that huge $11 billion market cap we just talked about, NuScale is fundamentally a pre-revenue company.
Okay, pre-revenue with an $11 billion valuation.
Yeah.
That's quite a statement. So what does the article mean by revenue in NuScale's case? Or lack thereof?
Well, it clarifies that any money coming in right now is from contracts just to plan the building of the reactors, not selling the reactors themselves.
Ah, planning contracts. And how did the author view those?
They describe these contracts as having no positive unit economics.
No positive unit economics, meaning they don't actually make money on those planning deals.
Essentially, yeah. The article says the income is basically a wash from costs. So they cover expenses maybe, but there's no profit per contract.
Right.
The key takeaway the author hammers home is that the company makes $0 in revenue today from actually selling its product, the modular reactors, or the power they generate.
$0 from the core product.
Okay.
And the timeline for that to change. Does the article give one?
It does, and it sounds pretty far out. The source projects, assuming things go smoothly, NuScale won't see any revenue from actual operational products until 2030.
2030. Wow. That's still quite a ways off.
And even then, the article suggests that initial revenue is likely to be, quote, negligible.
Negligible. Why is that?
Because these first projects expected around then are described as essentially tests.
Essentially tests. So the implication from the source is that the core tech itself isn't fully baked yet, either technically or maybe economically.
Yeah, that seems to be the angle. It calls the modular technology itself essentially tests, and flat out says it has not been proven yet that this technology can work economically or much better than large reactors.
That's a pretty strong claim about the readiness of the tech.
And to kind of drive home the risk here, the long timeline, the pre-revenue status, the article points to a specific recent example. That canceled project.
Ah, yes, the Utah one. Carbon-free power project.
That's the one. The source highlights it was canceled, citing delays and, crucially, cost overruns.
Right. Delays and cost overruns on technology that's still described as being tested. Not ideal.
Not ideal at all. So you put all that together, pre-revenue, long wait until maybe 2030, questions about the tech's economics, a major project cancellation. It paints a pretty clear picture of why the author is skeptical of that $11 billion valuation.
Yeah, you can see the argument forming. The author doesn't mince words then.
Not at all. The summary is pretty blunt. Describes NuScale as kicking the can down the road, calls the stock dangerous to buy, and predicts it's one-headed much lower.
Okay, a very clear negative stance from this particular analysis.
Definitely. So that's the case against NuScale, according to the source. Now, let's pivot. The article brings up Rocket Lab as one of the potential alternatives.
Right, and it notes their market cap is, around the same as NuScale's initially.
Around the same starting point, yeah, but then highlights the immediate major difference.
Let me guess.
Revenue.
Bingo. Rocket Lab actually generates revenue. The article puts their annual figure at $466 million.
Okay, yeah. $466 million versus zero product revenue. That's a stark contrast. What's Rocket Lab's business, according to the source?
It calls them a disruptive rocket launch and space systems company.
Disruptive.
And positions them as nipping on the heels of SpaceX in the launch market.
That's ambitious.
Well, the article makes a point of saying Rocket Lab is the only company besides SpaceX to consistently launch payload rockets for customers.
Consistently launch, that's key. And who are these customers?
Both commercial and the U.S. government. And the source notes they pay a pretty penny for these launches. Pay a pretty penny. Sounds like a valuable service then. Does it give numbers on launches?
It does. It says they've done 59 successful launches so far and have 31 more planned missions already in the pipeline.
59 successful launches. That's significant operational proof.
Right. And it's not just launches. The article talks about their space systems business, too.
Okay. What does that involve?
Building components, basically. Things like communication systems, solar panels, payload vehicles, the stuff in space.
Hardware side. Got it.
And it mentions a long-term goal for them to build their own satellite constellation, though the article admits it's unclear exactly what they plan to do with it yet.
Interesting. So multiple revenue streams, actual operations. What about future growth? What does the article point to?
The big one is their upcoming Neutron rocket.
A Neutron. Right. Larger rocket.
Much larger than their current Electron, yeah. And the thinking is bigger rocket, higher revenue per launch. Makes sense.
Simple math there. Anything else?
Yeah, just expanding that space system side of things and working through their existing backlog, which, by the way, the article mentions is over $1 billion.
Over $1 billion in backlog. That's a lot of future revenue already lined up.
It is. So given all the current revenue, the launch cadence, the space systems, the backlog, Neutron coming, what's the author's bottom line on Rocket Lab versus NuScale?
Well, based on what you've laid out, the article probably concludes Rocket Lab's on a much clearer path.
Exactly. The source says this trajectory should make Rocket Lab a much larger stock than NuScale Power in 10 years.
Okay. Clear argument there, based on demonstrated progress and future plans.
All right, so that's Rocket Lab. Now for the second company the source highlights, Rivian Automotive.
Ah, Rivian. The EV maker, the article calls them. What was it, a fallen angel?
Yeah, a fallen angel in the electric vehicle space. Points out the stock is way down, like 92% from its IPO high, and says it's trying to get its mojo back.
That IPO was definitely hyped, so what went wrong, according to this source?
It suggests their initial strategy was part of the problem. They launched with those really premium trucks and SUVs.
The R1T and R1S.
Yeah, expensive. Upwards of $100,000, the article says. Which, limited its addressable market.
Stands to reason. You can only sell so many $100,000 vehicles. How are their deliveries now?
The article mentions stagnating deliveries, kind of hovering below 50,000 a year.
Okay.
And it references reviews basically saying, look, it's a great car, but maybe not one for a wide audience at that price.
Right. Great product, niche market, at least initially, and financially. That lack of scale must hurt.
Definitely. The article says Rivian is struggling to generate positive cash flow without scale.
Makes sense. Car manufacturing is brutally capital intensive. Any numbers?
It cites a negative free cash flow of $1.86 billion over the last 12 months, which is a lot.
Ooh, yeah.
But it does get a little nuance there, noting that the free cash flow has actually improved recently, so maybe signs of progress on cost control or efficiency.
Okay, so challenges, but maybe turning a corner slightly. Still, the author picked them as having potential over NuScale. Why? What's the key?
One big thing, the upcoming R2 model, launching next year, supposedly.
The R2.
Right.
That's their smaller, cheaper SUV.
Exactly. Described as a mid-size SUV with a much more affordable cost of $45,000.
Okay, $45,000 versus $100,000 plus full. That is a completely different market segment.
Huge difference. And the article expects this R2 should greatly increase Rivian's annual deliveries to customers. Opens up that wider audience they need.
Right. Volume is key in the car business. So if the R2 hits, what kind of scale does the article imagine for Rivian?
Potentially massive growth. The source suggests revenue could jump from around $5 billion now to somewhere between $15 billion and $20 billion annually.
15 to 20 billion, that's a huge leap.
And potentially higher later on. Now, the article is realistic, notes that car margins are typically slim.
Always are.
But even with slim margins, getting to that kind of scale could mean, quote, at least $1 billion in annual earnings. Maybe like a 5% margin on $20 billion revenue, roughly.
Okay, so moving from huge cash burn to potentially $1 billion in earnings, that would be a turnaround.
A major turnaround. And compared to NuScale's zero product revenue until maybe 2030, You see the contrast the author is drawing.
Yeah, absolutely. One is about scaling an existing, albeit struggling, manufacturing operation with a new product. The other is about proving and deploying a fundamentally new technology category years from now.
Exactly. So the article's conclusion for Rivian, based on this R2 potential.
Let me guess. Easily surpasses NuScale's market cap in 10 years.
You got it. The article says this scale-up will easily help it obtain a larger market cap than NuScale Power in 10 years.
Okay, so let's tie this all together. The source's main point seems pretty straightforward then.
Yeah, the author thinks it's almost simple why Rocket Lab and Rivian could end up bigger than NuScale. What's the core contrast you think the listener should take away from this specific analysis?
Well, it really boils down to present reality versus future promise, doesn't it?
Yeah.
The article paints NuScale as this company with a huge valuation based almost entirely on future potential that's years away, faces technical and economic hurdles, and has already seen setbacks like that Utah project.
Right. It's the pre-revenue status, the 2030 timeline, the essentially tests description of the tech.
Exactly. Whereas Rocket Lab and Rivian, they have their own challenges, definitely. But according to this source, they're already generating significant revenue today.
Mm-hmm.
And crucially, the article outlines identifiable, relatively near-term catalysts, Neutron for Rocket Lab, R2 for Rivian, that provide a tangible path to scaling that revenue and maybe reaching profitability.
So the author's really negative view on NuScale stock isn't just like a gut feeling. It's tied specifically to that pre-revenue status and the long, uncertain road ahead. They see it as kicking the can down the road.
Precisely.
Yeah.
From this perspective, Rocket Lab and Rivian look like they're actually running down the road, even if they stumble sometimes. They're actively executing and have clearer milestones coming up soon.
So thinking about this through the lens of this one article, how does this comparison help you, the listener, maybe frame your own thinking about different kinds of companies?
Well, it presents a really sharp contrast, right? You've got the potential huge reward, maybe, from a breakthrough technology like NuScale's, but it comes with immense development risk and a very long wait. Versus companies like Rocket Lab or Rivian that are already in the market, already generating sales, and their path forward is more about scaling up, executing on known plans, even if those plans are difficult. Yeah. It really makes you think about how you weigh that future promise against current tangible execution.
Yeah, that's a great way to put it. So just to recap the picture this article paints, NuScale seen here as pre-revenue, facing big hurdles, long delays, and then Rocket Lab and Rivian presented as having clearer paths to more revenue and scale that, this author believes, could lead them to bigger market caps within a decade.
It's a viewpoint that definitely prioritizes current revenue and operational proof over long-term technological bets, at least at NuScale's current valuation.
Which leads us to maybe a final thought for you to chew on, based purely on this article's perspective. Given its really strong stance against pre-revenue companies with these very long timelines, what does that suggest about how you might evaluate other companies in similar spots? Other emerging tech, capital-heavy industries where real revenue is still years away. How do you personally balance that allure of the future potential against the hard reality of what a company is actually delivering today?
Yeah, that's the million-dollar question, isn't it? Or in NuScale's case, the $11 billion question.
Yeah.
Something to definitely mull over.